Okay, if you've touched crypto at all in the last few years, you need to stop and listen up. This is probably the most important explainer you're going to watch. We're not talking about the next bull run or some hot new altcoin. Nope, we're talking about the one thing that can absolutely wipe you out, even if you make all the right trades: taxes. Let's just dive right in because what you don't know here can seriously hurt you. This isn't some made-up scenario. This is a real story, a true horror story that happens to so many people every single year. Just imagine that for a second. You feel like a genius, you've made life-changing money, and then bam, the market crashes and you're still on the hook for a tax bill that's 8 times bigger than what your portfolio is even worth anymore. $67,000. That's the bill for profits that literally don't exist anymore. See, this is the brutal reality of crypto taxes. The IRS, they don't care that you lost the money a few months later. They only care about the profit you made the second you clicked sell or trade. This is the exact trap so many of us are just walking straight into without even knowing it. So how in the world does a nightmare like that even happen? Well, it all boils down to one fundamental misunderstanding about what crypto actually is, at least in the eyes of the government. So let's break down this core problem right now. Okay, this is it. This is the single most important concept you have to burn into your brain. The IRS does not see your crypto as money. They see it as property. Think of it like a stock or a collectible or a piece of land. And every single time you get rid of a piece of property, whether you sell it for dollars, trade it for something else, or even use it to buy something, you are creating what's called a taxable event. Just look at this list. Look how many things are on the you owe money side. Selling for cash? That's obvious. But the one that trips up literally everyone is trading one crypto for another. Getting staking rewards? That's taxable income. Using it to buy something? You just sold property. The only things that are really safe are just buying it with dollars, holding on for dear life, and moving it between your own wallets. That's about it. So let me ask you, be honest. Have you ever done this? Swapped some Bitcoin for Ethereum because you thought it had more upside? I mean, pretty much everyone in crypto has done this at some point. You guessed it. In the eyes of the IRS, what you just did was sell your Bitcoin property, and then you immediately bought Ethereum property. You owe tax on whatever profit you made on that Bitcoin the second you made that swap. It does not matter that you never saw a single US dollar. Okay, or how about something even smaller? You wanted to support the cause, right? So you used a little bit of crypto to buy a coffee. Seems totally harmless. That is also a taxable event. You technically sold a tiny fraction of your crypto holdings to that coffee shop, and you're supposed to calculate the gain or loss on that $3 transaction. It's crazy, I know, but this is how people accidentally end up with hundreds of taxable events a year and have no clue. Okay, so now that you're probably freaking out that everything you do is taxable, how do we legally minimize the damage? This is where we get into the single most powerful rule for saving money on your crypto taxes. It's all about understanding the two different types of capital gains. The difference is so simple, but it is so huge. If you hold something for less than 1 year and then sell it, that profit gets taxed at your normal income tax rate, which can be super high. But if you hold that exact same thing for more than 1 year, just 1 day over, it qualifies for the much lower long-term capital gains rate. I mean, look at this example. That's a massive difference in the tax rate just for holding on a little bit longer. Let's put some real dollars to it. Say you made a $3,000 profit on some ETH. You sell it after 6 months, you could owe the IRS $720. But if you just wait another 7 months, cross that 1-year finish line, your tax bill on the exact same profit drops to $450. That's a 38% savings just for being patient. It's a no-brainer. So holding long-term is the foundation. It's rule number 1. But how do we get a little more advanced? Let's talk about a couple of pro-level strategies you can actually use to legally and intelligently cut down that tax bill even further. This one right here is a total game changer. It's called tax loss harvesting. The idea is you strategically sell your investments that are down, the ones that are in the red. This creates a loss on paper. Then you can use that loss to cancel out the gains you made on your profitable trades, which directly lowers the amount of profit you have to pay taxes on.
Now, this slide shows you the pure power of accounting. By default, the IRS uses a method called FIFO, or first in, first out. On the left, you can see this means if you sell one Bitcoin, they assume you sold the first one you ever bought. If you got in early, that means a huge taxable gain. But you can choose other methods, like HIFO, highest in, first out. Look at the right. This lets you tell the IRS you're selling the Bitcoin you paid the most for. If the price has dropped since then, you can actually generate a tax deduction that you can use to offset other gains. Same sale, totally different tax outcome. It's powerful stuff. But honestly, while all these strategies are great, the most effective one, 9 times out of 10, is the simplest one. Just hold your good investments for over a year. It slashes your tax rate, it makes your life 1,000 times easier when it comes to tracking, and frankly, it usually forces you to be a better, less emotional investor anyway. All right, let's bring this all home with the most practical part. This is your survival kit. These are the tools and the habits that are absolutely non-negotiable if you want to avoid becoming one of those horror stories. So if you've ever even dipped a toe into DeFi, yield farming, liquidity pools, all that stuff, your tax situation just went from complicated to nearly impossible. This is a real number. One DeFi trader had almost 4,000 taxable events in a single year. Think about that. Just from daily rewards and compounding. Could you even imagine trying to track that in a spreadsheet? No way. And this is why I have to be completely blunt here. Trying to track this stuff manually in a spreadsheet is not an option anymore. Not if you're doing more than a couple of trades a year. It is a recipe for absolute disaster. You have to use crypto tax software. It's mandatory, not optional. Services like these are built to handle this insanity. You just connect your exchange accounts, your wallet addresses, and they automatically pull everything in and do the calculations for you. Believe me, it is the only sane way to get this done right. And beyond the software, it comes down to good habits. Don't wait until tax season to figure this all out. You'll be totally overwhelmed. Sync your software every month. You have to track every single little staking reward as income. And please, please, whatever you do, never lose the records of what you paid for your crypto. If you do, the IRS can assume your cost was zero and tax you on the entire amount. And finally, here it is, the golden rule. This one tip could have saved that trader from the beginning of our story. Every single time you sell for a profit, you immediately take around 30% of that gain and you move it into a totally separate, boring savings account. You don't touch it, you don't reinvest it. That is not your money. You're just holding it for the tax man. So I'm going to leave you with this question. I want you to look at your portfolio right now. After hearing all this, are those gains you see an asset you can actually use to build a better life? Or are they a massive, ticking tax bomb that you just haven't accounted for yet? The choices you make from this point forward will decide that answer.